Hi, my name is Ryan McLaughlin. I'm the team leader for the Pittsburgh CQA team. I'm currently a senior studying finance and data analytics. I was interested in participating in this simulation due to my background in private wealth management. However, I thought this simulation would broaden my experience beyond ETF and index investing and provide me with exposure to the creation of an individualized long-short portfolio. Post-graduation, I've accepted an offer at Freddie Mac to become a capital markets analyst.
Hi, my name is Juliana Trevi. I'm currently a junior at the University of Pittsburgh, and I'm studying finance, economics, and political science. I decided to do this challenge because I've always had interest in finance and learning about the markets and current events, but also financial literacy is a big passion of mine. So I just want to become more aware of what's going on in investing and also learning about more metrics that are used when valuing a company.
Hi, my name is Anthony Abenanti. I'm a junior at the University of Pittsburgh College of Business Administration, studying supply chain management and data analytics. I wanted to join the CQA portfolio management team to learn more about markets and how portfolio management works in an applied setting. I've always had an interest in finance, and I took this opportunity to learn more about it.
Hi, I'm Alex Sharps. I'm a sophomore at the University of Pittsburgh in the College of Business Administration. I am majoring in finance and pursuing an economics minor. I'm currently a senior analyst for Panther Equity, a student-run portfolio at Pitt. I wanted to join the CQA competition to sharpen my skills I've learned there and apply them in a different setting. This summer I will have an internship in London through the Global Business Institute from Pitt.
Hi, my name is Donald Kerr, and I am a junior here at Pitt Business, studying finance, economics, and law. As an alumnus of the inaugural CQA Institute, I wanted to help leverage what I learned there to help mentor the rest of the team this year.
My name is Jacob Keel, and I'm currently a sophomore at the University of Pittsburgh studying finance and accounting. I wanted an opportunity to take a foray into the public markets as I'm currently interning at a lower middle market private equity fund.
Our investment philosophy started with a top-down approach. So we were focused on different industries that we found attractive, and then from there we decided to pick our top 5 companies or stocks within that industry. Some of the industries that we were focused on were healthcare due to the recent split within Congress, financials due to the rising interest rate environment, and tech focused just to see some returns within our portfolio. However, since the duration of the competition was so short, we decided to switch this approach about halfway through the competition, in which we took a bottom-up approach. In this approach, we kind of targeted healthy businesses that were performing well throughout the last couple months, and no matter what industry, and focused on that rather than the overall hierarchy of the industry.
Some of the technical metrics we looked at when we were picking individual stocks, for shorts in particular, we looked a lot at current events, meaning that we looked at basically a lot of momentum for the stocks that we were reviewing. Seeing the momentum of a stock that was starting to go down, we then took advantage of and ensured that it would keep going down. In order to hedge our risk, we also engaged in some technical components such as stop losses and limit orders in order to sort of hedge our bets. And we also looked at 50 and 200-day moving averages. Stocks that had just dipped below their moving averages, we then targeted, as well as targeting and reviewing the 52-week highs and lows, because we didn't want to invest too close to a stock's 52-week low. We really wanted to pay attention to the momentum of the stock.
Some of the technical metrics we reviewed for our long positions were, yet again, the current events within the market. Obviously, that has a large swing on how a company performs, especially whether its stock goes up or down. We obviously looked at the PE ratio of the underlying company. We wanted to make sure that it wasn't too far off from the industry standards. And then obviously we were looking at previous earning reports and the guidance that they provided within those earnings reports. We wanted to invest in companies given strong and aggressive guidances rather than companies that were pulling back. Our portfolio construction originally started with a top-down approach, as we previously stated. But towards the end of 2018, we saw a lot of volatility within the market. So our original construction of heavily focused on financials, tech, and healthcare changed to more focused on just healthcare and tech. Around the end of 2018, we dropped most of our allocation to the financials and focused more on large cap growth opportunities that could potentially bring us back from our deficit that we saw within our first month or two of trading. The trading and rebalancing frequency, we started off with a bi-weekly approach. We would meet as a team every other week to review our 80 stock portfolio, 40 longs, 40 shorts. From there, we did a brief analysis on every one of our companies, decided which ones we wanted to sell from the short portfolio, which ones we wanted to sell from the long portfolio, and then obviously replace them with new companies.
So our asset allocation in 2019 changed from the top to bottom approach we originally had to a more bottom up approach, as we stated previously in the video. So we have since changed our allocation from looking at just an industry that we were interested to allocating more equally towards the different industries, and then selecting a few stocks that we feel more strongly about and allocating them a little more heavily.
So our portfolio performance didn't start off too hot. Within the first couple weeks, we were down roughly 8.5%, partly due to our allocation, partly due to what we invested in. But since then, we've obviously reallocated our portfolio and seen great growth within certain stocks we've picked. Currently, we sit at about 4.5% down and around 35 in the rankings. But we've seen tremendous growth within our tech allocation, especially Keysight Technologies, Netflix, and eBay. All of them returning over 24% for us. We've also seen a few big movers within healthcare from Celgene and AMD. They both are up roughly 20% since the beginning of the competition. However, we have seen some very bad losers, you could say. We've had to sell out of our position in NVIDIA, which was down roughly 15% when we got out of it. And then we've seen a couple of positions right now that are down a little over 25%, that being Ubiquity Networks and Mattel Inc.
Due to our initial allocations across many industries, we knew there would be different risk and return profiles for each industry. However, due to our heavy concentration in technology and healthcare, we expected for our portfolio to have a fairly significantly high risk return.
In more numerical terms, currently our portfolio is standing at a negative 0.6 alpha, and we have a 0.09 beta. Going into the challenge, we knew we had high beta stocks situated on both on our long and shorts, and thus we believe this created a hedging effect, which ultimately lowered our beta.